Welcome to the Nashville Money Guys YouTube channel. My name is Brandon McDonald. How's that date the rate thing going for everybody so far? I don't know why I just get so excited when realtors come up with such a clever little shtick, like a clever little saying, date the rate, marry the house. I wonder if people are like, man, I didn't think I'd be in a dating relationship for this long. I'm editing the video and I'm struck by this revelation that it's cool to understand all this stuff, and I think for me, it's interesting, but it's so granular. How does this actually affect you? So let me just cut in for 45 seconds. I know that there's going to be a lot of people that are instantly like, what are you talking about? If you're doing it the way that I think you should do it, which is in tumultuous times, you make safe bets. You don't make crazy bets. You don't anticipate the market going up. You cover yourself with speed. Paint and carpet rehabs that you're executing on quickly. You're closing on them quickly. You're estimating the rehabs conservatively, and then you're estimating the sales prices conservatively. I don't think this matters. I think you can literally scale a house flipping business into a downturn or a recession as long as you're doing it properly. Go fast, create a fantastic product that's the best house in the neighborhood, get it on the market, and list it at the sales price that everything else is selling for. No problems. We did that through the great financial crisis the entire time. The people that are getting in trouble right now did not follow those principles. They're dealing with the consequences of building a business that only works when things are going perfectly. 10% profit margins, and it's very helpful when the market is going up. But as soon as money gets more expensive and prices start softening, adios 10%, losing money across multiple deals, and then they have to recalibrate. Back to the boring, granular, worst-dressed Brandon. Let's talk about the inflation information that has just come out. It's April 10th, 2024. First article is from the Washington Post. You can kiss June interest rate cuts goodbye. Greg McBride, chief financial analyst at Bankrate, wrote in an analyst note, inflation came in higher than expected. The lack of progress toward 2% is now a trend. The intention of them raising rates, as Elizabeth Warren and Jerome Powell battled out in a hearing last year, they kind of want unemployment to start going up. Now, they don't want it to get crazy. They probably don't want you to lose your job, but they definitely want some unemployment to start happening. And this is the next part of what we're going to dive in here, which I think is so interesting. What type of jobs have been being created since we got out of COVID? And so when they're counting jobs, I think that we would all agree that the best type of job is probably a full-time job, right? Nobody wants there to just be an economy full of part-time jobs that are all paying minimum wage. I think everybody would agree that that's probably not a healthy thing. You see this part-time worker chart right here? That gain is a huge percentage of the new jobs that we've been getting. And I know that Jerome Powell and the Fed are looking at and going, there's a ton of government jobs in there. There's a lot of part-time jobs there. So technically, we are creating new jobs, and there's a lot of job openings right now because check this out. The labor participation rate, which I'm going to read you what the labor participation rate is. One reason many job openings go unfulfilled is that millions of Americans left the workforce during the pandemic and have not returned. The labor force participation rate, which is the participation of the total population over age 16 that's either employed or actively seeking work, has risen slowly during Biden's time from 61% in January to 62.5%, so 61.3 to 62.5. That still leaves the rate somewhat short of pre-pandemic level of 63.3 for February 2020. The rate has been trending generally down for nearly a quarter of a century. That's the important one. The rate has been trending down for nearly a quarter of a century. Almost 40% are completely considered out of the workforce. Now, that doesn't mean that they are out of the workforce. It means that the government doesn't know how to track these people to figure out, are you seeking employment? But look at this chart right here, this employment population ratio and labor force participation rate. If you look, this goes all the way back to 1948. 1974, right in here, compared to where we are now, there was this huge uptrend in labor participation, and then it's come back down. So it peaked in 1995, and then it's just been trailing off. And it's really difficult to keep GDP at maximum levels. So what they have been doing, because when you have that many people out of the workforce, what ends up happening is you have less productivity. You actually have a drain of productivity because those people are now having to be taken care of somehow. by their family, by the government, whatever the means is. They're not considered people that are putting in effort toward the economy, which would make the GDP higher. What happened was the federal government started taking interest rates at that point and bringing them down, 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 down. So in essence, what they did was say, labor participation is going down. We can soup up and we can juice the GDP by lowering interest rates. So bringing this back into why does this matter for real estate people? This correlates to the mortgage rate directly. Because when the Fed changes something and says, we're seeing inflation is sticky and it's not coming down where we want it. And jobs, even though they're kind of crappy jobs maybe, aren't exactly where we want them to be because we want them going down, which is scary and seemingly dangerous. And again, Jay Powell and Elizabeth Warren got into like a brawl where Elizabeth Warren was like, you want people to lose their jobs. And Jerome Powell was kind of like, you do too. Because we kind of all need people to lose their jobs, or we bake this inflation into the cake for the rest of the country, which in my opinion probably has already happened. What do we need to see for those that are dating the rate to really lock into a long-term relationship with that rate? Well, we need to see unemployment go up and we need to see inflation come down. So imagine there's a couple, a husband and a wife, and the husband, we'll call him Jerome, and the wife, we'll call her Janet. Jerome has realized we need to tighten this ship down. So he tightens his household spending down big time. And Janet is like, that is probably not what I'm going to do. And Janet just spends out the wazoo. What ends up happening to their household? Let's say before, Jerome's spending $1 trillion every 100 days. And then he goes, we're not doing that anymore. And he goes to zero. And Janet goes, I would like to continue spending $1 trillion every 100 days. Do you see what I'm doing here? That's the really dumb blue collar version of what's exactly happening right now. The household, the government, is still drastically overspending and just pumping a crap ton of money into the market, which inarguably is keeping inflation up, and it's essentially propping up this like zombie economy that we've been in for a while now. So how do you proceed in a market like the one that we have currently? If you haven't watched any of the Nashville Money Guys videos before, my thoughts are consistent, which is do fix and flips and go as fast as you can. Because there are still houses that are selling. So if you look at the Nashville rate right now, I'll put this up on screen. This is Nashville as of basically this month. We've sold almost the same amount of houses this year as we had at this point last year, and our median price is actually up. So are these metrics perfect to be like, oh, the market is super healthy? No, because there's probably a lot of behind the scenes data that, and especially neighborhood to neighborhood data that may say, I'm not interested in that neighborhood particularly. And there also may be something with the median price. There may be some houses that are selling that are completely skewing this data to make it look healthier than it is. But there is no doubt high interest rates on 30-year mortgages are absolutely affecting the real estate market. Go fast and do deals that are not difficult deals to do. Paint and carpet rehab, stuff that you can get in it and get out. Make sure that you are not being overly optimistic on the sales price on the back end. Make sure that when you're looking at the comps, you're looking at stuff that's, within the last 3 to 6 months that's actually selling. And if it's difficult to comp, make sure that you're really conservative. Right now, the lending environment is pretty tight. So if you're not super established with a bank or you're trying to do real big, gnarly rehabs, they're not going to touch you. That's what we do at Nashville Money Guys. So check us out at NashvilleMoneyGuys.com if you need a hard money loan to do your next deal. We're an asset-based lender. We don't care about you or your credit. What we care about is the deal, and that's what we're going to analyze. Seems like America's been holding its breath for quite a while. I wonder how much longer we can hold it. Check us out, NashvilleMoneyGuys.com. I'm Brandon McDonald. Thanks for watching.